Audit Planning and Fieldwork. Prepared by Group 3.
Assessment of risks. There are two types of risks: business and audit risk. First, business risk. It is a risk arises due to significant conditions, circumstance, events, actions or inactions that could prevent the achievement of organizational goals and objectives. There are many types of business risks such as 1. Operational risks, which is due to internal inefficiencies and failures like supplier delays in delivering raw materials or production delay. 2. Financial risks, which arise when there are fund management issues. For example, credit risk, interest rate risks or currency risk. 3. Strategic risks are risks that a company's strategy becomes less effective that may be caused by technological changes or a new powerful competitor. 4. Compliance risks, exposure to potential loss or legal penalties due to failure of laws or regulations compliance. Lastly, reputational risks are severe risks that could lead to loss of company's reputation due to customer complaints or product failures. Next is audit risk. This risk occurs when the auditor fails to detect the materially misstated financial statements even though the audit opinion stated that the financial statements are free from error or fraud. It consists of three types, which are inherent risk, control risk and detection risk.
Audit risk model. There are three types of audit risk model. 1. Inherent risk. 2. Control risk. 3. Detection risk. The formula to determine the value of audit risk is equal to inherent risk times by control risk and detection risk. Inherent risk. It is caused by an error or omission in financial statement and the absence of internal control. It could be influenced by the business characteristic and the business it operates. In a financial audit, inherent risk usually occur when transactions are complex, or in situations that require a high degree of judgment in regard to financial estimates.
Moving on to control risk.
What is control risk? Control risk is risk of misstatements as a result of the internal control systems. If the control is weak, there is high chance of material misstatements and auditors would not be able to detect all of those misstatements. This could lead to audit risk. And to minimize control risks, auditors should have proper risks assessment at the planning stages.
When there is high control risk, the risk of misstatement will increase, which could lead to an increase in audit effort. Thus, there will be low detection risk.
When there is low control risk, the risk of misstatement will decrease and will also lead to a decrease in audit effort. Therefore, there will be high detection risk.
Next is detection risk. Detection risk is the substantive procedure which will not detect any misstatement that occurs. It can be directly controlled by the auditors depending on judgment based on inherent risk and control risk. Additionally, auditors can decide which level of detection risk can reduce the audit risk to acceptable low level. Auditors responsible to carry out audit procedures such as substantive test and analytical review procedure where it provide assurance that misstatement can be removed and detected. High inherent risk and control risk, low detection risk. This indicates that the evidence collected is high. The auditors can consider an appropriate planning, direction and supervision during audit work. Extent of procedure involved. Timing of procedure estimated. And nature of the procedure, whether through internal or external documents.
Next is sampling. Sampling is an audit sampling, which is the application of an audit procedure to less than 100% of the items within an account balance or class of transactions for the purpose of evaluating some characteristic of the balance or class. Representative sample. A representative sample is a small quantity of something that accurately reflects the larger entity. For example, is when a small number of people accurately reflect the members of an entire population. Reasonable assurance. Reasonable assurance is the level of confidence that the financial statements are not materially misstated that an auditor, exercising professional skill and care, is expected to attain from an audit.